Your savings aren't where you'd like them to be. You may be considering investing in stocks and bonds. Here to tell us more about the process and what you need to know before you begin investing is President of Wilsey Asset Management, Brent Wilsey. Brent, great to see you.
Oh, good to be here.
Always is.
Yes.
Let's start with the basics. What's the difference between a stock and a bond?
Well, you know, Jason, it's kind of funny because that's a switch people might make, saying, well, I'm in a savings account, I'm getting interest. I think maybe I'll just invest in a bond. That's not a good idea, because what happens with bonds, as interest rates go up, which is a very, very good possibility, the value of investment goes down. So we're recommending stay away from bonds, even though they're touted as a safe investment.
Okay. What are the basics of investing? Somebody says, look, I've never invested before, but I see people making money in the stock market. I'd like to try it.
Well, it's very hard to get into. It's kind of funny, Jason. We used to do a 2-hour introductory workshop on the basic fundamentals. And people kind of look at us, their eyes will glare over like, oh my gosh, it's so complicated. Investing is not easy. So don't be concerned like, oh my gosh, I don't get this, I'm not smart. It's a whole nother thing you have to work with. So what we generally say is, first off, watch your emotions, because you get excited and you have a lot of these academies and so forth saying, oh, do this trading, do this. That's all the excitement side. You've got to be very calm when it comes to investing. And
likewise, you might ride a high because your stock going up, but then when it goes down, you want to control the emotion there too, right?
Exactly. And that's the funny thing too, is that they're the smartest people when things are going up. When they go down, they turn into not very smart people, I guess I'll put it that way. And it's because you've got to be patient. You have to understand the fundamentals of what you're doing. And that we always tell people when we're investing, and we do a lot in the equity stock side, that you're buying a small piece of a large company. That company is not going to do something in the next 2 or 3 weeks. It's going to take them 2, 3, 4, maybe 5 years. Be patient with the right investments.
What do you think is the biggest mistake that you beginning investors make?
To be honest with you, they try to do it themselves. It's very hard, and we tell people, hire a professional for a couple of reasons. One, the knowledge. I mean, we spend all day long looking at this stuff and so forth, and also to the patience and the emotions. We don't get emotional about it. So the biggest mistake people make is thinking, oh, this is easy, and it's not their fault. It's TV's fault, because you see these Wall Street firms spending millions and millions of dollars telling you it's so easy. Why? So you go to them, trade, lose all your money. Next, they take the next person.
Yeah, exactly. Can you tell us about the difference between a stock that pays dividends and one that doesn't?
Sure.
And what's your philosophy on that?
Well, we like both companies in our portfolio. We do have both. But the reason why a company will pay a dividend is because they have money, they have extra cash. We'll say, you know what, let's share with our shareholders, because they're the owners, let's share with them our dividends. Now, if a company's not doing it, they're saying, sorry, shareholders, we're trying to build the business. We want to keep this money so we can, buy more plant equipment, invest in R&D and so forth, so we're not going to pay a dividend. You want a mixture of both in your portfolio, because you want some growth and some income in the portfolio. Not a bad thing, but not necessarily you've got to have one or the other.
And you also, Greg, you mentioned the diversification there. You say it's good to diversify, but don't over-diversify. What do you mean by that?
Jason, that's so smart, because people think, well, if I buy a lot of different things, I'm going to do great. People do not realize that Warren Buffett, 60% of his portfolio's in 6 stocks. When people over-diversify, they never make any money. And because you got this, you got that, you got 0.2% of this, and it goes up, and people say, oh yeah, I made money on this. But such a small part of the portfolio. We have a concentrated portfolio, and we have an actual financial formula that shows 15 positions is the best. It's in finance books and so forth. No one uses it because, unfortunately, in the industry, a lot of salespeople, but the financial formula shows 15 positions, that's the best to have.
And you mentioned controlling your emotions. Warren Buffett once said, I've lost $1 billion in a day, and I've made $1 billion in a day, but either way, I'm having a hamburger and a Coke for lunch.
Exactly, that's very true. And that's what you got to look at. You're buying small pieces of large businesses. Don't worry about the craziness of the stock market day to day. I'll drive you crazy.
Do you have to have, we've got about 30 seconds left.
Sure.
Do you have to have a lot of money to start off?
No, I mean, for our clients, I mean, we try to tell them, I mean, if they have, our company is $100,000, but for sons and daughters, we want to get them started. We say you can start with like $5,000, and with that you can get like 4 or 5 different positions. It will be more volatile, but you can start about $5,000. But you have to know what you're doing, and you have to spend time doing it and control those emotions.
Yeah, the big time. Okay, Wilsey Asset Management is who to call, right? If anybody has any questions, you're the man to talk to. All right, Brent Wilsey, always great to see you.
All right, good to be in here.